Strain here at Hurley Investments. We're doing our Hurley Investments Market View commentary for Monday, June 29th. We're almost into July. Um, so I'll be making my end of quarter calls here pretty quick. Um, anyway, I've got a lot to talk about tonight. Kevin gave me some permission to go a little bit longer than I normally do if I need to. So because we got a lot to cover. Uh, so, and I'm changing the format a little bit in that I'm using a slideshow in PowerPoint instead of a Word document for the whole thing. I'll switch to the Word document, but we'll get you all this information too. So if you're unable to watch this live, we'll get it on the recording for you. So or up on the website. Anyway, so what I wanted to talk about today, there's a lot of things that have been coming up, and I want to talk about some of my favorite things to talk. I'm a total geek when it comes to option trading, right? I love digging down into everything and really understanding what options are, how you can use them, what the data means, what it's telling you, all that kind of stuff. Um, So today I want to talk about the Greeks, not these ancient Greeks here that were building all these temples and stuff, but I want to talk about option Greeks. And I'm sure some of you have been exposed to some of this, um, and you've probably heard people talking about delta, gamma, theta. Those are the three that I think are most useful to individual investors, retail investors. And I think probably even to professional investors, but uh, I find them very useful. So I wanted to talk to you exactly what these things are, why they're useful, and make sure that you actually understand them instead of because when we get stuff from the internet, it's it's hit or miss whether it's good, valuable information or whether it's just what people say. Um, Delta is something that I think people kind of understand, but don't really know what it is. And so that's why I want to talk about that one first. Um, Delta is a great tool, uh, and what it is exactly, and I don't know if you've all heard about what this is before, but what delta is a calculation that tells you the probability of an option finishing in the money. And I'm guessing that some of you have heard that for the first time. That's what delta is. Some people have called it poor man's probability because the calculations determine probability of profit on an option trade are a little bit more intense than they are for delta. And it's a different calculation, but it's often kind of close. So the probability of finishing in the money is what delta actually represents. So it is a probability calculation. And a lot of times you'll hear people say delta's 50%, or you'll hear them say 50 cents. And that's the other definition. And this is probably the more common definition that people are given what delta is. Uh, you've probably heard that delta tells you what to expect from your option price if the stock moves up by $1. And because probability, right, has a range between 0 and 100%, and a dollar has 100 pennies in it, right? And the values pretty closely go hand in hand. So if you say if something has a delta of 50 cents, it's 50%, or you can say 50 cents and people will understand what you mean. It can be used both ways, but the accurate definition of what delta is it's a calculation that tells you the probability of an option finishing in the money at expiration. So as you'd probably guess, based on the second definition, what happens to your option price if the stock goes up $1. Um, all call options have positive deltas because call options make money as the stock moves up. If it moves up by $1, then the increase should be something very close to what the probability of the profit finishing at expiration is. And so it works perfectly. Um, and put options, if the stock goes up $1, your put option that makes money as the stock goes down will lose money. So they all have negative deltas. Um, and there's a whole bunch of different ways that we can use this. Um, but other things that affect the prices or affect the delta values are the other factors that affect options prices. So delta prices, that probability wraps up everything, all the other factors that make options what they are. So at the money options have deltas that are really close to 50%. And so if you have a stock that's right on its strike price, the delta should be something very close to 50% or 50 cents. The further in the money or out of the money that, uh, well, the further in the money the option is, the higher the delta. So your exchange, if the stock goes up another dollar, the more in the money that delta is, the closer that option price is going to move with the stock in equal dollar amounts. It'll probably never get to 100%, but it'll get really close to where it's almost a dollar or really close to a dollar. If you're out of the money options, the deltas are smaller than 50% because the probability is less likely that that stock's going to finish or that option is going to finish in the money. All right, so who cares, right? Who cares what delta is? I don't have to look at it. I'm just a retail investor. I don't need to be educated. Well, I that's not 100% true because I and you guys probably know this about Hurley, right? We want we want our clients to be as educated as possible. We want you to be we want you to be good enough so that we can hire you to be advisors someday, right? We want you to work for us someday and become advisors yourself. We teach you everything what we're doing and the reasons why. Um, Delta is sometimes called the hedge ratio. You might have heard that phrase before. Why? Because it actually tells you how many options to buy or sell to hedge your stock. So if you have an option, an at the money option that's got a delta of 50%, and this is why I'm talking about this stuff because I want you guys to know what happens and what to expect when we enter our positions that we're getting into. Um, your delta of 50 cents says that you're probably, if that stock goes down, if you have a put option and it's the stock goes down or the stock goes up $1, you're probably going to lose 50 cents. Now, if the stock goes down $1, you're probably going to make 50 cents. That's not an equal representation of the position of what you thought, right? We're not gaining a dollar for dollar as the stock goes down. We're gaining some ratio of of what that is. So we're making up some of the difference when we put a put option on a stock, one for every 100 shares. We're not expecting to make 100% to the downside whenever the stock moves down. Um, and that's what I want to make sure you guys understand. We're not always expecting that we're going to get that whole value as the stock moves down because we still own the stock and the stock can bounce back at any point in time, right? Um, Another thing that delta does is position delta. So if you take the sum of your option trades, the sum of the deltas of all of the options in your trade, it'll give you either a positive or a negative number. And it can tell you if that number is positive, it tells you how bullish or how bearish the position is at any given point in time. Why does that matter? because you can tell when you need more or less protection relative to your investment goals. So if you're watching deltas and you're extremely bullish, but you're worried about something coming up, then you might need to change your position bullish bias to reflect how bullish or how bearish you are uh, at any given point in time. And that's one of the ways money managers use it. Portfolio delta, and this is the way the big boys really use it. They use portfolio delta to say how bullish their overall portfolio is at any given point in time, because you can add all those deltas up. And by the way, a stock trade, if you're bullish, you're long stock, that's 100% delta, because you're going to make $1 for every dollar the stock goes up, right? If you're short the stock, then you're 100% bearish delta. So you can still add up all the deltas in your portfolio and determine how bullish your portfolio is at any given point in time. Why does that matter? Because everyone who invests is going to be wrong at some point. If your account is 100% delta bullish and you're wrong, you're 100% wrong. And that's not good, right? All the time. You don't want to be 100% all the time on anything, right? So we know you're going to be wrong at some point in time. So we definitely want to have a bullish bias in our portfolio because the market tends to move up over time. But there are situations where we really don't want to be 100% bullish. So you can use those to just monitor your overall portfolio. Gamma. Gamma is another Greek. Uh, this one is defined, it's the rate of change in delta. So gamma tells you what your new delta will be after the stock gains the next dollar. So if delta is telling you, so you might have heard this called acceleration. If your delta is speed, how fast you're going, then gamma is going to tell you your rate of acceleration. So it can give you your 0 to 60 speed, right? And that's going to be different on different stocks. High stocks that have higher volatility, and it's going to be different depending on where your strike price is. All the other factors that affect option prices are still going to be there, and they're going to be important. But it so if you're and one of the things that we do when we buy put options before earnings, we want to be right at the money. And the reason why we want to be right at the money is because if we get that move to the downside, we our gamma is going to be at its highest. So that's where the rate of change, our speed, the quickness of our response to the downside is going to be at its highest at the money option. So when you get closer to your top speed, your rate of acceleration is going to slow down, right? So when you get further in the money, you're going to get closer and closer to hardly any change. And same thing when your car's breaking down, the engine's dying or whatever, and it's not working. You're really far out of the money. Your rate of change is also going to be much slower. So what does gamma help you do? Oh, I don't know why that says gamma's there. I'm going to change that real fast. Gamma. Um, Fat fingers, I guess. In position gamma and portfolio gamma, you always want to be gamma positive. So option buyers, when you buy an option, your gamma is always positive. If you're selling options, your gamma is always negative. So if you're monitoring your own portfolio, and gamma is probably used a lot more, and you might have heard of uh, professionals getting gamma squeezed. It's basically a short squeeze, right? So if you're gamma negative, you're short, and when you're short, your risk is unlimited. So if you have a really high gamma, you're short, and you better do something to change because your risk is really ridiculously high. There's gamma reports that different brokerage firms where the bosses they get these gamma reports. If it shows up negative, somebody's probably getting fired. Um, and if people were short and they were in long, a lot of short positions, that's the I'm sure you guys remember the GameStop short squeeze a long time ago. That was also a gamma squeeze. A lot of people had shorted options on the stock as people were going heavy into long positions, and those brokerage firms that sold those calls, which selling calls, that's 100%, that's the worst gamma, right? Selling a call option has unlimited risk, and they sold so many call options that they had to cover because that stock price was going up so fast. So that was both a gamma squeeze and a short squeeze. You can use those almost interchangeably. Um, Anyway, if you're gamma negative, you have an overall short position, which likely carries unlimited risk. You don't want that ever. Um, Evan would probably fire me if I got you all gamma short. We don't do that. That's not what we're looking for. The third Greek that I want to talk about is theta, and theta is a measurement that we really want to watch, and it's something that's really affecting our accounts right now. Theta is defined, it gives you the rate of decay in time value for an option. So if everything else stays the same, 1 day of decay is going to result in some loss of time value to an option. So in order to understand this, you first have to understand an options price has two basic components. One is extrinsic value, and that's considered time value. So you probably have heard those things before. And intrinsic value. So the amount that the stock is in the money would be called the intrinsic value. So if the option is in the money, let's say it's $1 above the strike price, then it has $1 of intrinsic value, and the rest of the value. So the way you calculate time value is whatever the intrinsic value is, however in the money the stock is, you subtract that from the value of the options, and whatever is left is time value. Einstein became world famous for as a scientific mind when he proved that time is not constant. And it's no different with options time value. It's also called extrinsic value. It's not constant either. While it is affected by the same factors that influence options prices, it does have a somewhat predictable curve to it. On the next slide, I'm going to show you theoretical time decay curve. Now, nothing in real life follows this curve. I'm only showing it to you because it's modeled, and it's just showing the influence of time value on the option price. Okay, so this is what the theoretical time decay looks like. So the farther out in time you have, the lower the rate of decay. And so you can use this a lot, right? So when we have a long-term expectation for a stock price, you'll see that we oftentimes will buy leap options, leap bull call spreads as a stock replacement strategy. That's our stock replacement strategy. And the reason we're going so far out in time is because that time decay, we're not trying to predict time value on the option. We're trying to predict the value of the stock. And so when we need a long time and we don't want time decay to be that big of a factor, we'll use those leap options that are way out there. And it's a little bit more expensive to buy leap options than it is shorter term options. But that time decay out in those long term time periods is so small, it's almost negligible. Um, and and so when we get out into that time frame, uh, that's that's okay because we have a long-term horizon for our expectation to happen, and that protects us uh, when we have short-term pullbacks in the stock. We'll set up those spreads, and the call options will we'll lose money, and we sold those options, so that works in our favor, and then we can last longer, we can wait longer, because that time value is not coming off so quickly. And so if the value drops by too much, we can make adjustments to our trade, or even pull off the short position altogether and just wait for the stock to come back. Um, so because we don't have to worry so much about the time value decaying really rapidly, that's the other thing. And you can see here that as you get into that last little bit of time, um, the last couple of weeks, it gets a lot more steeper in that second to last week, and in the last week it goes all the way to zero. It's an exponential curve, and it just really falls off quickly. One of the trades, that spread trade that um, Kevin gave me kind of credit for, and I kind of was pushing for it, um, before the Fed meeting. We put on that bear call, or that bear put spread on Micron, to just and really it did exactly what we wanted. It provided us with some protection without much cost to our overall position. But in that position, we actually wanted that time decay to happen quickly, because we didn't want to be in this for the long haul. Um, our overall long position was that this stock's going to get back up there, and it jumped back up pretty darn quickly. And so it didn't work out as far as one trade, but as for why we wanted that position to be there as a short-term protection, it was worth the cost to just get that on there and have the potential to make some more money. Now, this is what we have: a lot of positions in Micron, a lot of bull call spreads in Micron, and they're all deep in the money. I think our line in the sand, the option that we sold, the strike price is around 800. The highest strike price that we sold, I think, is around 800. So that's we are so far in the money already. And that's again why that short position, if we did get a short-term pullback after the Fed meeting, um, it could have worked out really good if we did, because then it wouldn't have affected our overall position, because that time decay is so slow in those leap options that we have. They're losing their value very slowly. And we're still holding those positions, and some of you are probably thinking, oh, these are taking forever. We're still in the same position. It's not really gaining a whole lot. We're just waiting for time to decay on some of those things. And believe it or not, the decay rate, even though it's slow, and it's happening, and it's happening over long periods of time, we can still make adjustments along the way if the options that we sold get cheap enough. um, then we could go ahead and buy them back and leave the other leg of the position on, and make potentially even more money, than we already have. But but really, what we're waiting for is for that time value to just come up, because we put these positions out there for a long-term position. And now the good news is, if we get assigned on any of those short options, it guarantees a max profit on the trade, right? So if we do get assigned, it calls it away. Somebody exercises their option, um, and we don't even have to. We're not even owning the stock, right? We don't even own the stock, but we have the right to buy the stock at a much lower strike price. And so that would be that would offset any potential um, margin call that we could potentially get or something, right? Uh, it wouldn't happen, because we have the right to buy those shares at a lower strike price. And so all we would do is exercise. If someone exercises their option on the short that we've got, we just exercise the option on the long, and it guarantees that we have a max profit. So that's and and we've got a lot of positions. We've got so much money that are tied up in that, and we're just waiting for it to fall off. If there's new opportunities, um, that have a greater potential than just getting the time decay, we could potentially pull some of those off that are really deep in the money, that are most of the value, and head that way. But until we have an opportunity, until we have a greater certainty of a better opportunity, we'll probably just keep hanging on to those. Um, some of you may have noticed we did some new positions, and these. So most of what we do is AI related and growth stocks, things that are just carrying the indexes. But we want to be a little bit balanced in there too uh, with some stocks that are just value. And uh, these two trades are value trades. They're both sports and apparel related stuff. Um, and we were kind of teasing each other around uh, that our wives are more interested in Lulu and all the guys are more interested in Nike. But I don't know. We'll see. Definitely Lulu's at a higher stock price, um, and uh, and we got into that trade. We got into both these trades, I believe, on the same day, um, and they're both longer term. This is going out to June next year, 27, longer term. It's really interesting, the story behind both of these. You can see the chart here on Nike. It was pretty flat here for quite a while, and usually that flatness is a technical setup for a potential big move coming up. That's exactly what I used to look for straddles positions on Nike. Um, and and so this one was really making me happy, and so we got into that bull call spread on Nike. Lulu has also been beat up as well, and it's going down there and had a nice bounce here uh, just this last week. So that one's doing better right now than Nike is, but we'll see how things turn out. It's also interesting that they've both got new CEOs. Um, they've both tried to get they both had previous CEOs that were uh, comeback specialists, right? That that wanted they and neither one of them, it didn't work out for either of them. So uh, and believe it or not, Lululemon's new CEO that starts in September came from Nike, and Nike's new CEO also came from Nike. He came out of retirement to come back to Nike. And while they both kind of shifted a little bit away from what made them so big in the beginning, these new CEOs at both companies are coming in to try and get back to what made the stocks great to begin with. Nike's CEO is really going to be focused on sports stuff. He's not going to be trying to do online sales and direct market stuff like they tried to do. That was just a miserable failure. And they're trying to get back into sports stuff. They're really I've been seeing so many commercials related to soccer and Nike shoes lately. So they're really trying to get back to what made them great. I love my I still have my Air Jordans that I bought years and years ago, and I still wear those to play basketball. Um, but I've got a new pair that I'm interested in. I just got to show you real fast. That's my next pair of Nike shoes that I'm gonna buy. A lot of you guys already know I'm a big BYU fan, so um, love sports, love football, love basketball. Um, got a friend who's one of the coaches at BYU on the basketball team. Uh, I just love those guys. So um, I have a BYU shirt for every day of the month, so I don't have to. I only have to do laundry once a month, and I can still wear a BYU shirt every day. uh, but it's fun. Um, we also did and this was today. We did a roll up on our Google because we had a Google call that was set to be called away at 3:40, and so all we did is we just did a roll up, and I want to show you why this is smart and how we're just using the we're just using the option pricing and all that kind of stuff in this case, and just to get more money out of this thing. And that's really what we do, that and why we're so good at what we do is we're using options to enhance performance of the stocks that we select, right? So we own Google. We're making a ton of money on Google. We've got all these long positions. They were set to be called away at 340. So that's this line right here on the lower line on the chart is at 340. And so it costs us, I think it was about $5 in total to roll up and out. So what we did is we bought back the options, the 340 call that we had sold, and then we sold the 380 for December. So we go up on the strike price and out on the expiration. It only costs $5. And I want to show you the pricing here. This is kind of unique here. This is my old company, um, Odds Analytics. Don Fishback has this great software that just helps you to value options better using all the information that we have, all the probability analysis and all that kind of stuff. And you can see here the option that we had, the 340 that expired in September. It cost us $2,700 to buy that back, and the value, and this is what Don does that's different than everybody else. He looks at how the model, the green curve right here is showing what the option pricing models are expecting, um, and so they're showing you what the market's expecting, and they're expecting the stock to fall under a log normal bell curve, and nothing ever follows those models ever. And so what he does is he goes back in time and says, over some period of time, and in this case it's 4 years. Over the last 4 years, if the stock continues to behave the way that it did over the last 4 years, what should that option price have been to be fair? And in this case, it should have been 24.40. And so it's about a buck or $2.60 too expensive to buy it back. But if you look at these options that go out to December, compare the value to the price, it's about $4.19 more expensive. So we bought back the cheaper one and sold an even more expensive one, and that gives us more times. And so for the trade-off is for about $5, we get another $40 worth of profit potential out of it, and we get a longer time period to work with. So it just made sense to go ahead and do that roll up. It'll pay for itself really really quickly. Um, if you're interested in learning more about probability analysis and the way to think about probability, so one of my pet peeves is, especially in our industry, you hear people talking about risk reward, risk reward, risk reward, and that's all they say. And it's frustrating to me because until you determine probability, risk reward doesn't mean a darn thing. Because it's like if it was just risk and reward, we should all be investing in lottery tickets for our retirement accounts, right? But the probability of success is so remote in that situation. There's no way I'd get sued to kingdom come if I was buying lottery tickets in your retirement accounts. There's no way. Um, but Annie Duke, this I really like this book. I made my entire family. I got it on Audible, and I made my entire family listen to it because I just want them to. It's not just about. In fact, the book, the first Annie Duke, if you're not familiar with who she is, uh, she was the most winningest poker player, female poker player on the planet for a number of years. Um, and the first chapter in this book is why this is not a book about gambling. So, and it's not a book about the markets either. It's just a book about thinking in terms of probability and adding probability as a factor. Because when you get down to it, everybody's going to lose in the stock market, right? You're going to have trades that you're going to lose on. Everybody's going to make bad decisions at some point in their life. So whenever there's a question And really probability analysis changed my life in so many ways. Um, the if 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 you think about probability analysis, it just changes the frame of mind that you're thinking about things. And whenever there's a question that doesn't have a yes or no answer, where the results can vary, probability analysis is the best way to make those decisions. It's to balance the risk reward and the probability to find out which decisions are going to work out best. And that's what we do. And it's so good for investing to think in terms of this way. Like I I heard Kevin talking about the trade last week that didn't work, and I'm like, I know it didn't work. I still stand behind it 100% as it was a good decision to make because it did exactly what we wanted. It gave us a potential profit um, and didn't really hurt our overall position uh, in that time frame. So it I felt like it worked great. It didn't have a positive outcome on that one individual bet, but investing is never about one trade. It's never about one trade. It's about the combined results of all of your trades. So if you this is a fun book to read. I think you can get it on Kindle for about $10. Uh, I really like listening to Annie read it to me herself on Audible. I like doing it that way, so it was really fun. Um, it's just a fun book to read if you're interested. All right, so I want to talk about a couple articles. This is it's just I think this is funny. I love making fun of perma bears. Um, People that are always, you get the big short guy. Um, you get this guy Jeremy Grantham and other people that's like they're perma bears are going to be right some point, in time, right? Because the market's always going to have corrections here and there. And so these guys that make their living off of, oh, this is bad, or this is bad, and it's, sometimes they come out and they hit it really big, but it's everyone. And again, are they good decisions? You have to balance it with risk, reward, and probability to find out for sure if they're making good decisions or not. Because overall, what really is important is, am I winning more when I win than I lose when I lose? That's the big key. Um, and you have to know how much you win or how much you lose on each time, and then reiterate it over and over till you get your probability. So that was just an interesting article to read, and I'll put the link up here if you want to read it. It's talking. He's basically putting his money into these big tech companies now, right? And it's like, well, finally, for a perma bear to come in and say, "Oh yeah, now it's time." It's like, well, it starts to actually make me a little bit nervous because if the last guy is finally capitulating to come over to the AI, the big AI names that we're doing, that could potentially be a bad sign, um, but it's not yet. I don't think so anyway. Um, then there's another article I thought. So some of you guys have Ford positions. I love Ford, right? I drove Ford trucks growing up. I my dream. Kevin has this Ford Raptor that I've been eyeballing pretty heavy, and I really like the Ford Raptor. I love Ford. It's good company. They're not going to go anywhere. They're not going to. Nobody here in the U.S. is going to let that company die. Um, but it's got some good stuff here. But this is have you thought of Ford as an AI company? That's the one question I'd like. Have you thought of Ford as an AI company? Okay, I'll get to your question here in a little bit. So I just saw some questions that came up that but I'll get to it. Sorry, I was kind of on a roll earlier and wasn't checking questions, but yeah, I wasn't thinking of Ford as an AI company, but here's this great article. It's talking about, to be clear, Ford doesn't mean it's abandoning its AI plans entirely, but it's using rehired employees, referred to as graybeard engineers, to train younger staff and to reprogram AI tools. Now, this is the thing with AI, is it's a probability engine. I understand probability stuff. This is what I do as an expert. I love probability and analytics that way. And AI is going to tell you what most people are doing, right? So if you want to get better than other people, you have to have human eyes to look at stuff. AI doesn't know, and I would love to support any attorney that wants to go after the person to put intelligent, the word intelligent in that name, artificial intelligent, because it actually isn't intelligent. It doesn't know why anything that it's doing. It's just pulling up the answers that have the most probable, that are most probably uh, going to be the right answer for you based on what it knows. And as you feed it bad data, you're going to get bad results. Um, and so these guys, and I think this is going to be a similar story for a lot of companies that are employing AI, is that they're going to hire people back because they need, and for every job that's been lost to AI, there's been people hired as AI babysitters to review the answers, but somebody has to understand whatever questions are being asked in order to make sure that AI is giving accurate and good results. So that's what Ford did. They're hiring these other guys back to help train younger staff and also to help new staff. And Ford's notorious. I mean, their engineers they way over engineer everything, and they use the same parts on all their different vehicles just because they're really good designs, right? Um, and so that's I just I really liked seeing this article. But the fact that they're not getting rid of AI, because AI does have some serious value in the time that it takes to get from nothing to something, for engineers, for a lot of different industries. It's still There's still so much to. We're nowhere near at the end of an AI bubble, I don't think. Um, it's going to keep growing. It's going to keep getting better, and reiteratively, as you keep repeating these things and keep getting that data back in, and it becomes more evident that other data is better, it's just gonna continue to grow and get better in performance. Um, we need to look at the big picture. Uh, this was really interesting. The big picture, the briefing, they were talking about Apple, and you know Apple took a hit because they raised the prices of a lot of their goods, right? And they were citing the fact that they can't keep passing on the rising costs of memory. But you know what? That's a good thing for us too, right? Because we're all holding those Micron we're holding those Micron options that are just killing it. And um so it's we're making money on the Micron. Yeah, we'll spend a little bit more on our Apple computer if that's what we're gonna buy. I'm an Apple guy. Um, I love my Apple products. Don't hate me for that if you're not. I understand the differences and why, but um, it's just easier for me. And but Microsoft is doing the same thing. Microsoft is also hiking their prices, on those things. And if you need evidence that the AI stuff is not over, I love this right here where Microsoft said they're raising uh, their Xbox consoles and memory prices have increased by more than 2.5%, or by 2.5 times, sorry, 2.5 times, and we expect another doubling by the fall of 27. So that's telling us we might need to be looking for some more long-term Micron bull spreads. So, and maybe that's what's next. We'll look at it on an individual. We'll keep looking at it. Um, The price hike announcements from Apple and Microsoft are important developments that leave the stock market with all its optimism about earnings prospects at a critical juncture as it makes the turn to return to the second half of the year. So again, I'm just going to keep harping on this. Inflation is not bad for the stock market. It's good. If they inflate prices, it makes their earnings go up, not down. Their earnings go up because they're passing on those costs. It's if they're not passing on those costs, that hurts the company worse, right? But if they're finally passing on the costs, it drives up earnings, and earnings continuing to rise keeps stock prices going higher. It's not until the Fed starts rate hikes, if they start fighting inflation, that's when inflation's bad for the market. It's not specifically inflation that's bad for the market. It's the Fed fighting inflation that's bad for the market. Um, so that's the that's the tipping point I would be a lot more concerned with. Um, we do have a Fed meeting coming up at the end of July that'll be interesting. It's funny that I love that Warsh, because when you say Alan Greenspan, who just passed away, um, the words come to your mind: irrational exuberance. If you're a trader, anyway, if you're a trader, the words irrational exuberance come to mind. If you're going to talk about Jerome Powell, you're going to say transitory. It's like they have these phrases or these words that make them famous, that everybody remembers them as a Fed chair, um, because of these words. And I can already tell you what Warsh's is going to be. It's the very first meeting. We have a what do you call them? Oh gosh, we have a committee for that, right? We have a committee for that. That's what it is. We have a committee for that. He said a number of times during that thing, when he was answering questions, and people were asking stuff, he would say, "Yeah, um, we'll have a committee for that. It'll tell us this." People were asking questions. Oh yeah, we'll have a committee for that. That's what he's going to be known for forever. Is we've got a committee for that. Um, so he's not going to give you the answer. He's just going to tell you he has a committee for it, and we'll see how that plays out. Um, we'll see how that plays out. Where will our markets end this week? I'm expecting we're going to end the week up, because all the technicals, when you look at these charts, Dow's technicals, that looks bullish. Um, SPX looks bullish, just crossed the 50-day moving average, heading higher. Um, Nasdaq, it's just right there, knocking on that 50-day moving average. If we have another day, so you can see the results of June so far, is down, but the market was up today. So the last week, we ended up down 1.5%. Overall, that puts us with these positives around 2.3 down, I think, or somewhere close to that for the month. But today the market was up 1.17, and if we are up 1.17 again tomorrow, we'll finish unchanged for the month. So my expectation is that it's going to end the month of June, probably lower, but there's a shot at being close to unchanged or close to break even for the month. Um, so that's good. Uh, and you can kind of see in these technicals on these, especially on the Nasdaq, it's like it hit some support there and started bouncing back up. I would draw a new support line right at that level. Um, and we'll just continue to hope these big AI stocks that we're in continue to rise. And we've got some positions now in value stuff. Ford has been beat up. Walmart's been beat up. Now we've got Nike and Lululemon. Those are value propositions that I'm firmly believe that they're going to be higher with some time. Um, Earnings this week, we've got Nike on Tuesday, so that's tomorrow. Um, Constellation Brands, Stars, uh, is what I always think of when I see the STZ. Constellation Brands is has earnings tomorrow. A few others. The BMNR is the Bitcoin mining company. it, nothing really big, but Nike is going to be important to us on Tuesday, and hopefully that's going to just be people buying into the the new marketing, going back to their roots at getting endorsements from athletes and building custom shoes for specific sports. Um, that's really gonna make that bounce back. Economic reports coming up. Today we had manufacturing survey and farm prices. Farm prices were up almost double what they were last month um, today, so that was kind of interesting. But to me, that signals inflation, and until the Fed starts fighting inflation, I really don't care. Um, well, I do care because I don't want to pay more at the gas pump. I don't want to pay more at the store. I do care. I won't say I don't care. Uh, but but I do care. What I don't care about is to the stock market, to my investing. I don't mind inflation at all if it's driving stock prices higher. It's not until the Fed's fighting that I start to get worried. Um, Tomorrow, Case Shiller Home Price Index. Not there's not job openings. Beth Hammock speaks. Um, there's a few Fed speakers on Wednesday. Kevin Warsh is going to speak. When they speak, sometimes they'll say stuff on these things. So that's why I put those on when they're speaking as economic reports because I watch them. Um, I because they can say stuff when they're not on the FOMC conference call that does cause a change in the market, especially Kevin Warsh. Whenever the Fed chair is speaking, people are listening and hanging on to every word that he says. And so I'm still going to watch and listen. I don't think he's going to say anything in this speaking assignment that is going to upend anything. So we'll see how that goes. Um, and we have jobless claims are reported a week or a day early this week. So instead of on Thursday, they're going to be on Wednesday. And then the employment situation, which was going to be on normally is on a Friday, is also being done early. And that's the one. There could be something there, but this is the thing. This is a market holiday week, and so people are going to be checked out by the time this stuff hits on Thursday. They're going to be checking out on Wednesday for a long holiday weekend, right? So we're going to have low liquidity situation on Thursday, and that could mean we'll have some volatility if these numbers come out, um, and it's something that's unexpected. We could get an extra volatile reaction from it. The market will probably overreact or underreact to the information pretty badly. But we're going to do what everybody else is probably doing is we're going to wait till Monday and evaluate what people said or did over the weekend and whatever comes out. So we probably won't be trading on this day. We'll be watching and we'll be here in case something does happen that we need to take action because that's what we do. But but a lot of people will be the market will be in a low liquidity situation on Thursday, so we'll probably not make any trades on that day. We'll reevaluate and make changes on Monday, and we pretty much got most of our assets are pretty well positioned right now. Google was the one that we needed to change today, um, but we'll see how things play out over the weekend. And that is all I have. That was kind of a lot. And I did take a whole hour. So any questions from anyone? Oh, Maud, I sorry I didn't answer your question. On a bull call spread, you're deep in the money. the profit is limited by that. You're right. The profit is limited by the call that you sold. Um, but and even though that profit is limited, you don't get the full value of it until the time value falls off. And if someone exercises that option, that's the good part. It they're getting you the they're giving they're getting you out so that you're if they exercise the option on you, they're calling away shares and you can just exercise the other option and there's no time value in that transaction. It's just a stock transaction at that point. So you're super happy about that if that happens. But that's what we're waiting for right now is for that time value to fall off because we're being limited right now by the fact that there's still time value on that option. So if we buy it back, we have to pay a price that we don't want to pay. So yes, you're right. And if we do buy it back, now if we decide that, it's a good time to buy it back, if we can get out at what we feel like is a pretty cheap price, then we could buy it back. And then the call option that we have has unlimited profit potential. And so if we think that that's the way it's going to go, we could potentially buy those back at a price that we think is cheap if we think that the profit potential of going higher is even better. So we'll we'll because that option also has intrinsic value, it's probably not going to happen that way. So that's why we're just waiting right now. Is just waiting for that to go. So you're welcome. Happy that helps. Um, any other questions from anyone? So when we get this stuff posted, you'll have these links, and you can go to read more on these different articles. Um, you can go on Amazon and look for that Thinking in Bets book, uh, if you like. Um, it's all good stuff. You guys don't have to worry because this is what we do for you. So if you don't want to do any of that stuff, you can just be happy that we're watching your stuff for you. All right, no questions coming in. Um, oh, yeah, so there's not a specific good question. That's a great question, Nathan. Is there a generalized portfolio delta or portfolio gamma that you're aiming for? We're never going to have a gamma that is negative. That's the cutoff, right? If you're gamma negative, you have potential for unlimited risk, and one bad trade could wipe out your entire business, right? One bad trade. If you were short GameStop, right, when GameStop got short squeezed, that could ruin your entire company for, I mean, it's just horrible. So gamma is never going to be negative. Anything that's positive is going to be okay, acceptable. Um, Delta is you always want it to lean if you're in for long-term investing, and there's a whole bunch of different standards that people will use on that kind of stuff. Different companies actually even have different standards on what they want their uh, portfolio delta to be. Um, but as long as it's somewhat positive, I would say I probably don't want to. I would say circumstances are very rare that I want to be 100% delta um, on my portfolio. But that's a really bullish, aggressive bet to be bullish. And if you're wrong, it's painful. So I would say something in the area of 70 to 75% positive for a portfolio delta is good. Even something that's 50% is okay because then you're if you're able to make money and be non-directional, if you have a delta of 50%, then that's telling you that it can go either way, that you're not directional. And individual trades, there's a lot of individual trades that I love to be a delta of 50%. We did one, and the one that we did uh, on Key Corp recently, we put the position in a delta neutral position where we and it worked out great. We were slightly biased to the upside in that position, and it decided to move up, and it worked out great. We ended up being profitable on it. We got rid of the puts for a little bit of profit, or not profit, but a little bit of money. We saved some of the money, so we got them cheap. And that's the important thing on that is when you're delta neutral, you have to get in at a very good price. If you don't get in at a good price, then it's not a good bet. So depending on what your history is and what your probabilities are, and that's what I would say is probably a better question to ask. So your question is there a general portfolio delta that you're aiming for? I would say if you don't know for sure what that delta should be until you have a probability figure to go with it. Um, if you have a probability to, because it depends on what your success rate is and how much you win when you win and how much you lose when you lose. So the overall value should be considered in that kind of a framework. Is this delta good with this probability? And I can go into that. In fact, I'm planning to do this. I'll go into that more, balancing risk, reward, and probability the next time I teach this class. Um, I'll go into that a little bit more detail of what makes a trade a good trade, or what makes a portfolio delta a good delta versus a bad delta. Because you can have a really fantastic delta, and if your probability sucks, it doesn't matter. So kind of getting back, you've always just got to balance it with risk reward and probability. So that's a great question. I love that. Um, uh, Matt's asking, can I show you how to find mispriced options? That's I would be happy to do that. I love that's what I do. That is exactly what I do. So that's this tool that I was showing earlier. Um, has this right here. That's what I use. Um, and and so I can go into exactly a little bit more about what it is. The cost I think is like $7 a month to get this app, and it will help you. And all you have to do is look at the actual ask price and the bid price and compare it to the value, whether you're buying the option or selling the option, and that will help you know whether the thing is a good deal or not. So that's a really good tool for doing exactly that. It's not the only way, and I have some scans that I use to help me find situations like that as well. But I ultimately bring it into this tool to confirm what I find. So I could do that as well. So I might do those in two separate sessions. So I'll do one. The next one I'm going to do though is going to be on risk, reward, and probability, making sure that you're looking at all three of those, because there's a mathematical formula that all actuaries use um, to help you determine whether something's going to be a good deal or not. So so we'll get into that a little bit deeper. So great questions, and thank you for giving me topics for the next few times I teach. So excellent. All right. Well, if that's it, I'm going to go ahead and let you guys go. I hope you have a wonderful 4th of July weekend. 250-year anniversary, right? Um, this there's so many things going on that could there's so many things going on. I hope you just have a ton of fun and have a great celebration this week, and we'll see you back here next week. All right. Goodbye. Thank you so much for coming. We'll see you next time.